In March, we saw the voluntary wind down of the crypto bank Silvergate Capital, the swift collapse of Silicon Valley Bank, and the Swiss bank Credit Suisse having a shotgun marriage to UBS just before falling apart. But now, after teetering on the edge of failure over the past month, JP Morgan and Chase has taken over the majority of First Republic Bank's operations after a Sunday night deal, making it the largest U.S. bank failure since 2008. Let's go through a nice timeline of the events that have led up to the failure of First Republic. Before the collapse, as interest rates have risen over the past year or so, the company saw its net interest spread, which is the difference between the rate it receives on its loans and the assets compared to its cost of borrowing, shrinking from 2.58% in Q4 2021 to 1.74% in Q4 2022. So this was before you saw any really major change in the stock price. No collapse at this point, but it's already looking a bit riskier as its earnings, or its net interest margin, which leads down to its earnings, has shrunk. So during the series of failures and takeovers in March, First Republic saw its about $100 billion in deposit outflows, which is due to its roughly 80% being of its 177 total deposits being uninsured. So all those uninsured deposits, they were getting scared. They were running to the big banks. They were pulling out all their money. In addition to that, so the FDIC backed the deposits. They've received then $30 billion in support from a coalition of banks, including JP Morgan, to help the shortfall from the deposits all withdrawing, but they still roughly had a shortfall of $70 billion. In the same announcement of them receiving funding from these banks, they also suspended their dividend. Great sign so far. So, and this was all in March, and now we're moving a bit forward. So a month later, we see the Q1 earnings, which show the extent of the bank run, all the details, all the hiding operating costs, and all the restructuring parts of it. As the short-term loans it has taken on were based on higher interest rates, its running cost to borrow was pushed up to 2.73%, up from 1.76% in the last quarter. So a 3-month difference, and they're up a whole percentage point practically in their net borrowing costs, which is massive for a bank. In the last quarter of last year, it was only 0.19%, just to give you an idea how it was already increased. On the other hand, loans were only 3.66%, up from 3.51% in the last quarter, compared to 2.78%. So yeah, they were getting more on their loans, but not nearly as much of an increase. It was about a 2% increase on the borrowing, 2.5%, versus 1% on the loans, what they were receiving. So a big difference in the spread getting crushed. Their net interest spread is now 0.93%. However, this also includes their non-interest-bearing loans, so those are your checking deposits and accounts like that, where they're not paying money on it. When you only consider the funds which the company is paying interest on, this cost to borrow is actually 4.33%. So that is more than what they were receiving from their loans at 3.66%. So just holding on to these loans, we're losing them money, meaning that they now need to offload these loans, and they would realize significant losses on their books, as many of these securities have decreased in market value over the past year compared to the accounting book value, as they're considered being held to maturity at the time, so they don't actually realize the market value loss as they occur. They only realize the amortization, which skews it, and this is something which we also saw in Silicon Valley Bank. So as the bank effectively had no other choice because they were losing money on it, they have to offload these loans. They announced this, but the market didn't like this, of course, and they shouldn't like it. So the day following the earnings, the shares fell, rightfully so. It cut from at 16 the previous day to about $8. And by the end of last week, the shares were only trading at $3.51. And just a reminder, before the fall at the March, when all the banks were collapsing, the company was trading at about $120 a share, a 97% for a bank in over a month. Last weekend, regulators seized the bank and had an auction for the bank's assets, with JP Morgan taking over the majority of these assets. JP Morgan will pay the FDIC about $10.6 billion, but this fiasco also cost the Deposit Insurance Fund, which the FDIC runs, an estimated $13 billion more. We'll have these final figures probably work out in the next couple of weeks. So as far as the First Republic shareholders go, they receive nothing again. So your equity holders wiped out. This is not the first time JP Morgan has taken advantage of distressed financial companies. They were a big player in the 2008 crisis. They took over Bear Stearns, and as well as Washington Mutual, the previous largest U.S. bank failure. But it still is. It's the largest, and then this is the largest since that. Regulators waived the 10% total deposit limit, which JP Morgan was already past. So now they're even a bigger bank. And there's your too big to fail coming up in 5 years or so. I just about that. No idea if that's going to happen. But in summary of the event, the bank has been having seen a shrinking net interest spread already. Then the bank saw a significant outflow due to these uninsured deposits, which further crushes net interest spread to the point of losing money on its holding loans. In other words, they failed at the core operation of a bank, lending more from what they can borrow for. If we look at the causation events, it's similar to SVB. Management failed and it exacerbated a bank run. The company could have immunized its interest rate spread by running into swaps. It's a very common thing. There's hundreds and hundreds of trillions of outstanding swaps, just to give you an idea. It's not like it's an obscure market. They could have done this. Banks do it all the time. And they wouldn't have seen this issue where their spread gets smaller and smaller. It would have stayed the same, but it would have been slightly lower than it would have its peak. And that's what they were doing. They were taking on more risk. And then once the interest rate structure starts to change, they're starting to accumulate that risk. And then it hits this point and it crushes the bank immediately. So as I've said before, though, any bank can really be susceptible to a bank run. Even the biggest banks, if there's a big enough bank run, they'll get taken out. But the riskier bank and the weaker the operations like we saw here, the more likelihood it is. So you can say, oh, it's the bank run's fault. It's the companies for pulling out. No, it's really the management's fault. You can add like 1% onto people taking out their money, but pretty much anyone would do if you were in their case. If you saw your money actually at risk, if you weren't insured, you'd probably be doing the same thing. And then it's the bank's job to understand these risks, and they did not understand the risk clearly.
Awesome.
Yeah, I mean, psychology is really everything when it comes to the banking industry. I mean, there needs to be trust. The whole point of a deposit is that you can access it when you need to, but if everybody accesses it at the same time, I mean, the bank doesn't have all your money there. The business model of the bank is to take deposits and then loan those out. So if enough people want their money back in a short enough period of time, the bank has to deny them.
Yeah, that's why you have to run it well, right? You just have to run it well, and these just weren't being run well.
Yeah, exactly.
I mean,
and then of course another issue right now is that banks, with some of their capital that they use to return deposits, they'll put into treasuries. Well, if you bought treasuries, a couple of years ago, then with interest rates going up, the prices of those treasuries decline. Then if you have to go to the market and sell them so that you can pay back depositors, you're selling them at a discount. So it's a bad thing when it happens.
Yeah. And I mean, like Warren Buffett alluded, I mean, this was the beginning of April. He ended up going on CNBC Squawk Box, alluded to, he basically said, we're not over bank failures, but depositors haven't had a crisis. And he says basically banks go bust, but depositors aren't going to get hurt. And then he goes on to say, the costs of the FDIC are borne by the banks. Banks have never cost the federal government a dime. The public doesn't understand that. He added, nobody is going to lose money on a deposit in a U.S. bank. It's not going to happen. You don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about. So again, it just comes down to, managers making a dumb decision and then, everybody panicking, run on deposits.